Hey everybody, welcome to the Milwaukee Real Estate Market update for October 2022. We're covering this and how it impacts your real estate decisions. I'm here to give you all the info that you need to make the right decisions regarding your real estate. Should I buy a home now? Should I be selling? Is the housing market about to crash? If you're new to the channel or returning because you found value in previous videos, it would mean the world to me if you could take a second to subscribe to the channel. Also, hit that bell icon. Make sure you get notified when we post more content like this. I'm Ty Ash with Houseworks Collective at Compass, your local real estate expert. Now, let's dive into current events and how that might impact us here locally in Milwaukee. Diving into our current events and highlights. National housing numbers, according to Fred, a data source that provides all kinds of great data. 753,000 homes available for sale versus 732,000 homes last month. That's up 3% month over month, which is pretty normal this time of year. We're starting to see some of that normal seasonality come into play. Compare that 753,000 homes with 564,000 homes in October last year, or up 33% in inventory nationally. For some historical context, we're still down right about 40% in inventory compared to July 2019. This was really the last time that the housing market was functioning normally, meaning months of supply was nearing 4.0 and affordability was stronger with rates right around the 5% range. This is kind of a different story from what we have here in Milwaukee. Active listings are down 23% to last year, a pretty big spread compared to the national inventory being up 33%. What I'm going to start pulling up here is just a couple Redfin charts, so we'll take a look at this year-over-year chart that shows the Milwaukee metro area active listings and the percent change over time as well. So this black line is our 2022 inventory, and you can see it's running well below the last 3 years. The bottom half of this chart is also showing that we're seeing some of the biggest declines as a percentage in active inventory as well. Now, why is this? New listings. On a unit basis, we continue to run lower than the last 3 years, and we're seeing a percent change drop faster than the drop in sales that we're currently experiencing. We'll talk more about that in a moment, about why this is a problem for people that are looking to buy here in Milwaukee. But before that, one last note on some inventory metrics, specifically in foreclosures. This isn't something we've really dove into in previous videos, but I think it's super important to bring up. With a recession looming, isn't there a really high chance of there being foreclosures in our near future? Well, here's a chart that we're pulling up on the screen from Adam Data that shows the full story. This chart dates all the way back to 2005, right before the Great Recession and the housing crash, all the way through September of this year in 2022. And what you're probably hearing in the headlines is that foreclosures have more than doubled versus a year ago. What they aren't covering, though, is how many of these foreclosures started prior to the pandemic. How many foreclosures were there even last year? And what we're seeing is a lot of the foreclosures that are happening now, and we're seeing that uptick, were actually deferred because of everything going on with the foreclosure moratoriums. Now you're saying, okay, well, when's this inventory going to start hitting? Well, typically the average time that it takes for a foreclosure to go from start to complete is 885 days or 2.5 years. So if you're still waiting around for some good foreclosure deals, give me a call in 2024 and you're still probably going to be disappointed because as you can see in this chart, we're well below the historical numbers of foreclosures. The homeowner out there today has a really great balance sheet sitting in a good position. Moving on to the next bucket where you've got inflation. Finally, some good news and a glimmer of hope. This data is from the U.S. Bureau of Labor Statistics. U.S. consumer prices climbed 7.7% in October from a year ago. The biggest driver still continues to be energy at up 17% to last year with everything going on globally, including war and those other factors. We're also seeing year-over-year increases in food prices as well as all other items, which really just includes the items that you purchase and the services you use every day. So think shopping and shelter or rent. Some extra info, and we'll kind of pan through these charts real quick. Food prices, like I mentioned, up 11% over the last year, driven by food at home, which typically has a correlation with gas and transportation costs, how much it costs to get that food from warehouses into your local grocery stores. The energy category increased 17% versus last year, driven by both commodities, oil and gas, as well as the energy services like electricity and natural gases that goes into your home. All items less food and energy rose 6% versus last year. And this is actually the bucket that actually rose the least amount and is actually slightly below the average, sitting at 7%. But one note is that shelter, which is inside of this CPI bucket, is actually about a third of the total CPI basket and how they measure that 7.7% inflation. So it's very likely that this will continue to drive inflation and be sticky because most leasing done for shelter is done in 12-month increments. So it's likely that we'll see this continue to drive that to be a little bit higher than the 2 to 3% range that the Federal Reserve wants to see. Finally, we got some good news on inflation, and typically what that means, we got a great report that came out last Thursday, and then the very next day on Friday, November 11th, 2022, we saw a considerable improvement in mortgage interest rates, on the national average basis. So from Mortgage News Daily, we can see that the one-day change was around 55 basis points, or about 0.5%, landing at 6.67% interest rates, and that's compared to still 3.1% a year ago. So still a significant gap, huge change that happened year over year here. But due to the good news on inflation this month, now there's a little bit of optimism that the Federal Reserve can finally take their foot off the pedal and ease up their interest rate hikes, which the last 4 have been 75 basis points, and it's been 6 consecutive months of them raising rates. What I really want to highlight on these interest rates this month is the spread between the mortgage rate that you're getting as the home buyer and the 10-year Treasury. And why we were essentially able to see a 0.5 percentage point drop in your mortgage rate at pretty much the exact same time that the Federal Reserve is saying we're raising the rates another 75 basis points. So how can that happen? So here on the screen is the 10-year Treasury alongside the average 30-year mortgage rates all on one chart. So to start 2022, here in this year, the spread between these two rates was about 1.5%. And obviously with a huge spike and all the volatility in mortgage rates, that has now led to a spread of about 2.7%. So we essentially have this 1% spread that's typically not there because there's actually a very high correlation between these two charts and the risk associated with owning mortgage-backed securities or the 10-year U.S. Treasury, because the U.S. can always print more money to pay you back. What's happening is lenders are baking in the risk to their rates, knowing that there's going to be a very strong chance of refinances in the next 24 months. Take a look at the average mortgage rates dating all the way back to 1971. It's right up here on the screen. First, 6.5% to 7% rates are truly an outlier in the last 10 years, but at least we're not back in the 80s. You can see that kind of on the far left-hand side here. And second, at each gray shaded vertical column area here, that indicates a recession. And nearly every recession here on the chart, the rates have dropped over the last 50 years whenever a recession occurred. This is due to the action the Federal Reserve takes whenever they actually go into a recession. They want to speed the economy back up they just raise these rates. Well, then they'll start scaling them back again. And that actually allows people to start going into safer vehicles such as 10-year Treasury and all those things, as opposed to volatility maybe in the stock market. And if that rate lowers, that then allows mortgage rates to come down as well, just because of the the risk of the asset. The supply essentially is relatively the same, but now there's way more demand during those times of volatility. As we look at this, when will we know when this is actually coming? Well, the jobs report and unemployment data is really what we're going to be focusing on. So currently, you can see on this chart, nationally, we are at about 3.7% unemployment rate as of September, versus here in Wisconsin, give our local context, we're sitting at 3.2%. So congrats, Wisconsin, doing a little bit better than the national average there as well. Many of the past recessions, excluding the COVID recession, all started around 4 to 5% unemployment. This is likely going to be a leading indicator to the Fed that they can finally start easing up rates. So now we're going to take a first quick pause. What other national headlines are you looking for more information on? And what things are under the covers that, maybe the national headlines aren't really diving into? Ask me in the comments below. I'd love to give you my take on current events and how it impacts the real estate market. Let's dive into our local market here in Milwaukee, obtained through the local MLS data. So in October 2022, residential homes, so single family and condos in the Milwaukee Greater Area, sold listings 1,300 homes, down 29% to last year. Active listings, 2,800 homes, down 23% to last year. Note, this month, we have actually seen this sold to active percent change relationship flip again. I always talk about this of what, down 29% sold versus down 23% active listings. There's a 6% spread here, meaning our months of supply increased month over month because less inventory sold than what's currently on the market. Well, it's flipped back and forth several months now, and that's just showing essentially the volatility we're having in the housing market today. It's really not fully functioning the way that it should, like it was back prior to the COVID pandemic. Next up, October new listings down 19%, and while it's not as large as the decrease we had in the sold listings, we're not replacing the inventory at a fast enough rate. In addition to this month's decrease, September new listings were down 23%, and August new listings were down 27%. So several months in a row here stacked up with negative new listings. And as a result, months of supply, 2.2 months versus two months last year. A slight increase versus last month, but that's normal seasonality. We'd love to see this get closer and closer to 4 months to present ourselves a more functioning housing market. And median days on market, 22 days versus 21 days last year. Homes are still moving very quickly versus historical precedents. And then the median sales price, $290,000, up 8% to last year, which was $268,000. We are seeing, month over month, that's come down a little bit. Again, we're in that time of year where there's the seasonality of seeing some of those prices come down because the winter months, less people are moving at this time of the year. And next up, for the investors out there, I've got the update on your two-family MLS stats in Milwaukee County specifically. Sold listings, 140 properties, down 31% to last year. Active listings, 315 properties, down 55% to last year. So, some definitely a slowdown here in the sold listings. Inventory severely disadvantaged. If you're not working with an agent that has off-market opportunities, you're probably getting pretty frustrated with the amount of opportunities that you have to evaluate. New listings coming to the market. 180 properties, down 24% to last year, slightly outpacing the rate of the sale decline. Months of supply, significantly lower than last year, 1.7 months versus 4 months. And then median days on market moving faster than that residential space at 11 days versus last year, 18 days. And finally, our median sales price, $172,000, down 4% to last year. So yes, this is kind of a weird dynamic because supply is definitely much lower than demand here. So why is prices falling? One click lower. If you look at essentially the difference of the inventory price range we have, if you look at Duplex inventory, $180,000 and less makes up about 52% of our inventory, is down 27%, as opposed to the prices of $180,000 and higher, which makes up 48% of our inventory, was down 35%. So we just happen to be selling more inventory at that lower price range. So really, we're probably not seeing too much movement in the actual price. When you don't have a functioning housing market with enough supply where buyers can go and shop and sellers can list and there's predictability of where they're going to sell at because there's enough supply, you start getting these weird changes month over month on the median sales price. Now it's time to talk about what does this mean for our buyers. Up on the screen, here's a chart of the active inventory in Milwaukee, again, right around 3,000 units available. The most recent healthy, functioning market was back in 2019, mostly pretty much across the nation here, where we had closer to 5,000 units available for sale here in Milwaukee. Now, with the slowdown in new listings, limited construction that we have going on in our Milwaukee 4-county area relative to some of the national new construction scene, as well as the demographics of the up-and-coming millennial homebuyer coming of age, it's really hard to see us improving this active inventory in the near future. If you're waiting for price drops outside of the normal seasonal pricing fluctuations, you may be waiting in vain. If you're waiting for interest rates to fall, be ready to enter into more competition, very similar to what we saw in 2021. If you can take action now, it's likely that you will be able to take advantage of this imbalance that we're experiencing in supply demand and experience these continued increases in pricing at the median price for homes, which means appreciation in your pocket. And really what we're holding out for is that refinance opportunity. So if you've got the ability to buy now when competition is much lower, down 40% actually nationally is the drop in pre-approval applications, this might be your opportunity. But if you need support in finding a way to bridge the gap between making mortgage payments now and what your monthly payments would be closer to a 5% average mortgage rate, it's really an opportunity for you to explore the 2-1 buy down, where you can ask for the seller to pay down those first 2 years of interest rate and essentially negotiate yourself a better monthly payment for the first couple years while we bide you some time. And now sellers here in Milwaukee, it's like a broken record. Tune out the national headlines, consult your local real estate expert. Your home has most likely not lost value here in the Milwaukee area. Inventory is still drastically low. Transactions are still closing super quickly. The best homes that are well marketed, that have good photography, are priced well relative to the comps that we're experiencing now and not 6 months, 8 months ago, receive multiple offers typically, usually within a week to 2 weeks. Very accelerated, time frame there in terms of receiving accepted offer. And in the month of October, the closed transactions percent of ask price was 99.1%, the exact same as last year. Historically, this percentage, and you can see it right here on the chart, was much lower even in 2020. In the middle of the year, we had essentially the same, percent closing as a percent of asking. Typically, our home sellers are move-up buyers. You're moving up to a nicer house, maybe a more favorable school district, or you're downsizing. You're going from a house to a condo because of, where you are in your current life goals. You're relocating based on personal or family reasons, as opposed to getting a great deal, which I feel like is what everyone's feeling like, they might have missed out here in 2020 and 2021 where interest rates were so favorable. Since they're buying in the same markets they're selling in, that's typically not the case, and we should start to see that return back to normal if people move for life events. This still remains one of the best times to sell because you're getting a great value for your home and you're probably getting a little bit of ability to negotiate against those buyers. But at the same time, you're competing against these first-time home buyers that haven't had the chance to build up the equity and put down those larger down payments. And usually you're operating with a little bit more favorable financing in the eyes of the seller here in the local market. So, be inspired that this might be one of your best times to sell your home and then move on to the next that we've seen in really the last 12 to 18 months. All right, and to wrap this all up, if you found value in the information that's covered here in the Milwaukee area, please subscribe, hit that bell notification so you know when we post content like this. Follow some of the shorter form content I put out on Instagram at TyAsh31. Definitely follow me there to find out more. Next time that we post this market update, make sure that you're on that notification list so you know what's going on to help you with your real estate decisions in the future. Also, give us that thumbs up if you liked this. Drop a comment below. What things did you like about this video? What things would you like us to do different? Thanks, and we'll be back again next month with your real estate market update.